Renowned economist Peter Schiff, famous for predicting the 2008 housing crisis, is once again cautioning about potential challenges in the U.S. housing market. Although today's conditions differ from the subprime era, Schiff highlights the combination of high home prices and rising mortgage rates, which could create stress for homebuyers and homeowners. The housing market imbalance. For years, the Federal Reserve kept interest rates near zero, allowing borrowers to lock in mortgage rates as low as 3 to 4%. This artificially inflated home prices as buyers could afford more expensive homes with lower monthly payments. Today, mortgage rates have more than doubled, with the 30-year fixed-rate mortgage above 6% compared to rates below 3% in recent years. Despite this, home prices haven't fully adjusted, with the S&P CoreLogic Case-Shiller Index showing a 50% price increase over the past 5 years. Schiff explains that this mismatch between home prices and borrowing costs may lead to affordability issues. As mortgage rates rise without a corresponding drop in home prices, this could pressure the housing market, leading to painful adjustments. U.S. economic considerations. Schiff believes that the shift toward rate-consistent pricing could create localized housing stress, particularly for homeowners who may need to sell but find they owe more than their homes are worth. Supply constraints also continue to cushion the market. Zillow reports a housing deficit of approximately 4.7 million homes, contributing to elevated prices. Additionally, homeowners with locked-in low rates are less inclined to sell, limiting available inventory and further exacerbating affordability. If these pressures intensify, even a small number of distressed sellers could have an outsized impact on local markets, especially in areas with limited supply. Gold as a safe haven. Amid concerns about housing affordability, gold has emerged as a preferred investment for many. Schiff believes gold could reach $4,000 per ounce by the end of the year. Major banks, including J.P. Morgan and Goldman Sachs, share similar forecasts. Unlike fiat currencies, gold is not affected by inflationary monetary policy, making it a long-term safe haven. Investors are also turning to gold IRAs to diversify their retirement portfolios and gain tax benefits. The role of rentals and real estate income. Despite concerns about potential home price corrections, one consistent trend is the rising demand for rentals. Rents increase year over year, providing steady cash flow for real estate investors. Warren Buffett has emphasized the value of income-generating real estate, noting he'd pay $25 billion for 1% of the nation's apartment complexes. Platforms like Arrived allow investors to buy fractional shares in rental properties, starting at just $100. This offers an easy way to participate in rental income without dealing with property management or tenant issues. Final takeaways. The current housing landscape is influenced by multiple factors: past low interest rates, rising borrowing costs, limited housing supply, and consistent rental demand. Schiff's warnings about potential price adjustments are a caution to homeowners, but for investors, real estate continues to offer opportunities, especially in rentals and fractional ownership models. As the housing market evolves, careful navigation is needed to balance affordability, long-term value, and investment strategies. Whether for home buyers, homeowners, or investors, staying informed is key to making smart decisions in the current market. For direct financing consultations or mortgage options for you, visit Nadlan Capital Group.